Hello, my friends. Today is July 26th. My name is Joseph, and this is my July FOMC debrief. Now, I'm going to briefly go over what I thought was most interesting about today's Fed conference. But before I do that, I want to level set so we all know how we got to where we are today. So let's back up a little bit. In June, the Fed paused. So for the months preceding June, the Fed had been hiking rates at every meeting, and in June, they decided to pause. Now, they paused, but they also gave guidance that they would hike rates 2 more times this year. Now, between June and July, we had economic data that was broadly stronger than expected, and we also had inflation, notably the recent CPI print that was lower than expected. Now, going into this meeting, Fed speakers had broadly telegraphed that, July is going to be a meeting where we hike rates. And that is exactly what happened today and brings us to where we are today. So the Fed obviously does not like to surprise the markets and hiked rates. Now, in this meeting, people were looking for extra information as to whether or not the Fed would continue to hike rates. Many people noted that very soft CPI print, and the market has begun to think that the Fed maybe is done with this rate hike cycle. Chair Powell addressed that pretty directly and said that that's only one data print. We look at a whole bunch of stuff, and maybe if we continue to see really soft data CPI prints, that would change our mind. But right now, we're going to be very data dependent, which is totally fair. After all, this economic cycle has not been as anticipated. So it makes sense to be, as Chair Powell would say, humble and nimble. So there really wasn't any clues as to how the Fed would behave next, other than the fact that between this meeting and the next meeting in September, the Fed is going to be able to see a lot of data on wages, on GDP, on labor market, and so forth. So I think this is going to make for volatile trading whenever those key data prints are out. Now, all in all, I think today's meeting was pretty boring, simply because Powell didn't really give too much new information. But there were some interesting things. Now, the first interesting thing, of course, is that the Fed staff are no longer forecasting a recession this year. And you can see that in the Fed's statement as well, where they slightly upgraded their assessment of the economy from economic growth from I think modest to moderate. So that's slightly more. I wouldn't read too much into it, but it's a slight acknowledgement that economic growth has been better than expected. Now, the way the Fed works is that every Fed president and Fed governor, they have their own view and they vote according to it, and they have their own people as well. But the Federal Reserve Board, of course, they have their team of professional, full-time staff economists that have their view as well. And their view over the past few Fed meetings was that we're going to have a recession sometime later this year. Of course, these are also the same people who were telling us that inflation was transitory, so keep that in mind. Now, it seems like more recently, as of this meeting, the Fed staff has thrown in the towel, and they are also no longer forecasting a recession this year as well. Again, the economy is stronger than expected. And if you listen to my prior videos, there is some indication from my perspective that maybe we kind of had a recession last year when we had 2 quarters of negative GDP growth, and maybe we're reaccelerating right now, which we seem to be. Okay, so stronger than expected economic growth, that's one thing I noted. The other thing that I noted is a little bit more wonky, is that the Fed is open to both cutting rates and conducting quantitative tightening at the same time. Now, traditionally speaking, the Fed doesn't like to do things that might confuse the public. So if they're hiking rates, they want to be shrinking the balance sheet. If they're cutting rates, they want to be doing QE, right? So you have 2 tools. You have hiking the interest rates as one tool, and you have the balance sheet as another tool. You want the 2 tools to be going in the same direction. Otherwise, the common thought was that you would be stepping on the acceleration and the brake at the same time. So you didn't want to do that. But Chair Powell today, he was open to basically saying next year we could cut rates and we can let QT continue on. And that has been my view as well. I gave an interview most recently with MNI News saying that seems to be the direction we're headed towards. And Chair Powell, again, this would be totally new for the Fed, but is open to it as well. And if you're super in the weeds, this actually has some interesting implications for both, overall banking sector liquidity as well as interest rates. Because if you're open to doing quantitative tightening, even as you cut rates, then that means QT can go on for quite some time. That's a lot less liquidity in the financial system. And that means, of course, there's going to be more treasury issuance that the market has to absorb. So it suggests that interest rates, upward pressure on that. And I think that's really all that I thought was super interesting in this meeting. So very brief debrief today, and we'll talk again this week with my weekly market thing on Saturday. All right, talk to you guys soon.